It's important to realize that what I'm illustrating here is just simply an example of the level of precision that's available when you understand what you're looking for. The common misnomer is, and you hear a lot of these, supposed professionals that come from institutions and come from, ex-banker of the, this, that, and the other bank. It's rather silly, actually, okay, to hear these folks say there's nothing on lower time frames but noise. Now, admittedly, in the 90s, I subscribed to that same view only because it was told to me in dozens of books that I wasted money on. So I present this only to illustrate that when someone understands price action, it's not that it's noise. There's a narrative that's going on, and it's price delivery. So we have to understand that there is a wide, diverse opinion across the board with technical analysis. One of the things that ruffles a lot of feathers with me is that I candidly come out and say 90% of what you're learning is fluff. And right away that will be very polarizing. Folks that are very team-oriented in their mindset about who they learned from, who taught them the system or whatever the system it is or method that they try to use in their trading. They immediately want to go on the defensive and tell me how I'm wrong about my perspective. Now, again, I'm not trying to rally up everyone to try to defend your supply and demand, your Elliott wave, and all that other stuff. I don't think there's any valid reason to pursue that, and that's my personal opinion. I've studied all that stuff and quickly realized that that's not the answer. Okay, so I kind of like want to just give you a little bit of an understanding what it looks like when you understand order flow. And this is by no means any complete exhaustive teaching on order flow. And it's a very deep subject. There's many concepts that you have to understand to fully appreciate the level of precision. But nonetheless, I teach a lot of this stuff. And then, yes, this sounds like a shameless plug, but I don't teach everything that you see here in my free tutorials. You will see a sampling of things, and the overall premise will be what is shown in my free teachings and videos. If you put time and study with the free tutorials and years and years and years of practice and have your patience forged, you might come close to some of the lower level mentorship teachings. But you won't have everything because there's simply gaps in the teaching on my free tutorials. So, again, with all that said, it's not important for you to join my mentorship. In fact, if you want to just study the free stuff that I put on my YouTube channel and you've grown from that, wonderful. I love getting those emails too. But nonetheless, I teach a lot of this stuff in great detail in the mentorship. So, and I'll give you some more information at the end of the video if you want to know more about that. I won't bore you anymore with it here. All right, so if we're looking at the British pound versus the US dollar, now again, this is a 1 minute chart. Forget time frame. Right away, some of you are going to be thinking, is this the time frame I trade off of? No. I can trade off of this time frame, but it's not the time frame that I trade off of. I get a lot of questions, and I'll answer it here. That way it saves me a lot of time and retweeting it. The time that I usually execute on is usually a 5-minute chart or 15-minute chart. My setup generally is seen on a 1-hour chart or 4-hour, and my bias or directional premise is derived from the daily chart, and most of the time in this kind of like the same direction on a weekly chart. Unless I'm trading off of a higher time frame dealing range from either a monthly or weekly or daily chart, I'm usually trading in some measure of institutional order flow. Now, institutional order flow, what is that? It is the understanding of where the price algorithm will seek to move price higher or lower. I don't subscribe to the opinion and common view that's bandied about in trading that markets go up and down because of buying and selling pressure. I don't believe that at all. I believe 100%, and no one's going to convince me otherwise. So if you're new to me and you just found me because of this video or whatever, I'm really not interested in trying to be swayed. You probably think that's a very closed-minded individual, so therefore, I'm probably very arrogant and stuffy and full of myself. You're welcome to have all those opinions. I've been doing this for 27 years. You're not going to convince me otherwise, okay? I'm only putting this out there for you to investigate and see if there's anything of value that you could take away from it for your own trading. So with that said, the 1 minute chart, I'm kind of like answered, and I said a lot about this on Twitter in recent months. There are folks that teach other people, and they will tell you that lower time frames, no one can find any consistency with it. In fact, I send a lot of times, every month or so, I'll send a tweet from a gentleman that I don't even know where I picked it up from, but I recorded it and kept it because I think it's funny, where it says, no one should try to ever time the market and beat the market, getting in before a big move and getting out, and no one can do it consistently. And I find that very, very amusing because in my community and on my Twitter, I show examples of this every single week. So again, it's a lot of stuff out there that you're going to be exposed to that simply is nonsense. It's nonsense. Just because these folks that tell you this don't understand how to do it, in no way, shape, or form does it make it invalid when I tell you that it's possible, because I show evidence of it every single week. So last Friday, what's today's date? Let's see here. Yeah, the 23rd. The 23rd, I revealed a personal algorithm of my own, and I don't teach it, so don't ask, please. But I showcased a way of working within order flow on what would otherwise be viewed as a choppy market in the dollar CAD. And between that and running up a trade in euro dollar, I was able to harvest 175 pips. And then yesterday, I showed 102 pips trading the same type of approach. And right away, I got a buzz on Twitter, and most of my mentorship group were sending me emails too. Am I going to be teaching that? And I had to hurry up and squash that, because as an educator that gets paid now, and much to a lot of folks' dismay, it is what it is. It's the only way for me to protect my intellectual property. I had to incorporate, and now it's my content, and I hold the copyright, so I don't want anyone feeling they can take it and sell it and repackage it without any kind of response from me on a legal front. But the view of having seen how I did that using limit orders, both sides of the market, buying, limiting out on the long, and then limiting in on a short, and the limit orders were waiting there for me, so I can see the turning points in price before it happens. No one does this stuff. No one. Not the guys from Goldman Sachs. Okay, they're not the guys from UBS. Not the guys from Citi. None of those guys do what I'm showing you. The reasons why they will scoff and say intraday charts are all noise is because they don't really understand how the markets operate. They're taught from a very myopic view on price. Many times it's from a long-term macro fundamental basis. And now I'm not going to get on a rant about how fundamentals do or don't supply value, because to some degree I do believe that if you're going to equate fundamentals to price action, if you're going to be using the differential for interest rates, then I agree that fundamentals are salient. But apart from that, I don't rely on it, and I don't care. And I'm still pulling out ridiculous, insane precision. Okay, so this is going to be one more example, and I'm not going to do any more of this because all it's doing is drawing more attention to the interest in my personal algorithm. And I'm not teaching it, I'm not selling it, and I'm not doing signal services with it. Okay, I just simply answered a response to some goober that posted on a video saying that I'm waiting for a trending market to trade. And I don't rely on a trend. It just makes it a lot easier when you understand higher time frame order flow. And if you trade in that direction, your trade setups will work. if you're in sync with that. The problem is most people don't understand what the order flow is at any given time. And while I won't really go into that here because it takes multiple videos and other supporting theories like open float and just a myriad of things that needs to be covered, some of which I hinted at in free tutorials, and you can pursue some of that in my YouTube channel. It doesn't cost anything but your time to go and watch those videos, and I promise you, you will learn more about price action from those videos than in any book anywhere on the subject, period. So I would kind of want to ask you a question. If you look at price action where we're at right now, disregard the reaction down here for now, okay? We'll get to that later in the video. Disregard the low down here. We're not concerned about that. What I'm asking you is look at this movement here, and it'll run up to this level, then this movement down to here, okay? If I were to ask you what do you see, rather? If I were to ask you what do you see in that? If we were all in a room coming from different backgrounds, from different technical approaches to trading, from different studies and disciplines of trading, invariably we're going to have a wide range of views about what they would collectively see. And my question is when you look at price action like this, are you looking for patterns, or are you relying on indicators to tell you overbought, oversold, divergence, all those types of things, or are you reading the tape? Okay, what do I mean by that? Before I put the annotations on my chart, okay, you obviously saw at the beginning of the video where I had a short from very close to the high and then inside this retracement, and then rode all the way down to a run below these equal lows. My mind thinks about what orders are resting in the marketplace. Okay, the things that work in technical analysis are the very things that don't exist in your charts. And I say this a lot, and I don't really give too much thought about when I'm saying it, how much confusion or mystery it raises, but it has come to a great deal of interest, even with my personal mentorship. Members are asking me, what do I mean by that? And it's simply this: it's liquidity. The price action that you see on your charts are not a response of buying and selling pressure. There's nothing to do with harmonic patterns. Nothing Fibonacci made these moves form. Trend lines had no bearing on how high and how far or when these things occurred. The price is moving because of the central bank, period. That delivery of price, because they are the storehouse, they are the producer, the supplier of price itself for the individual banks, like Bank of Japan and Bank of England, the Bank of Canada, and Federal Reserve for the U.S. The price coming from that central bank is what creates these patterns on your chart. Now, I already know, Joe Schmo from XYZ institutional firm is going to rebut me and say, oh, you don't know what you're talking about, yada yada this and yada yada that. Price is all about supply and demand, and it's not. It's absolutely not. It's not. It's not. Price is 100% manipulated. Okay? If you believe that price is going up because of buying and selling, that means we could literally take all these markets down in one day. If it was simply that. It doesn't happen. They're controlled. There's limits. There's thresholds that they will allow price to trade within. I'm on record many, many times for over 20 some years now stating that the daily high and low is formed based on a peg that's set at midnight in New York time. So when we see the daily highs and the lows form in these currency pairs, you think it may be a random walk forward of buying and selling pressure. It's not. I have shown many examples, both on Free Public and in mentorship, where I've been able to nail the high and the low of the week and the day. Before it happens, before it forms, I already know what's going to happen. Now, that probably sounds very arrogant. Oh, now I know this is a scam. I know exactly what you're thinking. This is the reason why my teachings have taken years, because if I came out on the scene and told you, I could do this, right away, nobody would have paid attention. But I have a rather large audience that have grown to trust me because of my ability to show it. But my introduction to it was to ask you all, what do you see in price? I started this whole thing with the introduction of specific, highly loved indicators. Because if you have an affinity for indicators, you are thinking the same way as everyone else in retail. So you're all thinking the same. And if everyone is struggling, by far and large, if you looked at statistics, most people lose money trading. And it becomes rather obvious when you take a step back and look at it. These are the same characteristics that all the same losers are having. So why are you doing those same things, expecting that you're going to be treated differently from the universe? Someone's going to, say, hey, look at this guy. He's working really hard. Let's reward him today and give him insights that no one else has. Out of the same group of people following the same things in these books, you're going to be the one that gets preferential treatment. No, it doesn't work that way. I thought the same stuff, so don't be offended, because that's exactly what I was lulled into believing back in 1992. November 5th, 1992, I sat down and considered my passive interest at the time in trading and investing, and I got hooked on it. But everything that I learned from books, I have since dismissed. Now, I do see things from a retail standpoint that I know gets traders really excited. They like their indicators, they like their divergence, they like their moving average crossovers, they like their trend lines being broken, and they like their horizontal support and resistance. They love those things. And I love the fact that they love them, because it gives me a great edge on knowing when smart money is going to reprice the opposite direction. With that said, let's go into a little bit of detail here. I taught a premise called the market maker buy and sell models. Now, right away, just to kind of like head off the guys that want to come into the comment section and tell everybody that I'm teaching Wyckoff, I was trading these ideas before I knew about Wyckoff. Now, Wyckoff is way before ICT, way before Michael Huddleston, way before I was even born. Okay, this guy was talking about marking up in a price move and marking down, and it would be of great interest for you to go and study whatever you can from Wyckoff. And then once you have done that, if you're wanting to be a student of mine, join the fold and research what I teach, and you'll see that there's nothing remotely close to the level of precision that I teach using what would otherwise look similar. If you look at this consolidation in here, okay, Wyckoff would teach, here's consolidation, here's a spring or a run below this low here, then it runs up, and it comes back as a retest, and then shoots up, and then starts to sell off. Well, that's all fine and great, but what's the premise behind it? Why should it form? See, the problem is, once I had already learned how the market books price like this in futures, because that's how I started as a trader. I didn't start as a Forex trader. That happened as a complete transition in 2006. 1992, I traded and started as a futures trader or commodity trader. By looking at multiple views of my initial real mentor, Larry Williams, no, I did not go to his house. No, I did not go to his workshops. No, I did not go to his seminars. But I studied and bought everything the guy put out. And it wasn't until I got with him and his material that I had a little better understanding about what price was likely to do. And then from there, I dismantled all that stuff and then went even deeper. Now, I'm not trying to disrespect Mr. Williams, because I'm so thankful that he put out his books. I'm so thankful that he put me, in the initial stages of my development. He had a video course, the Futures Millionaires Confidential Trading Course. It was 4 VHS tapes, and it's very hard to find it. If you go on eBay, once in a while you see it, but it was like, I think it was, if I'm not mistaken, $300 or $290 or $275, something like that. And it was 4 VHS tapes, and there was a section in there that I would always look at, and I saw what was understood later on as a market maker sell model. And it was very similar to what you see here. Okay? And I knew right away that there was something to that fractal, or that pattern, if you will, or price structure, because I kept seeing it over and over and over again. And it wasn't until this guy on America Online, because that's what we were using back then, everything was message boards and I guess instant messages that would come up in the right hand corner. I think that's what we call them, instant messages. If it's not, then everyone that's in their 40s or late 30s knows exactly what I'm talking about. Instead of like a DM or direct message today, I think it was instant message. But that was our internet. That was, I mean, we watched the whole transition from open outcry markets to electronic trading. But on one of the message boards, there was a guy talking about Wyckoff. And in true form, as a noob, didn't know what I was doing, I was trolling this guy because I thought I figured it out with a 50-day moving average and stochastic bullish divergence on an hourly chart. So, and commitment traders too. And that was kind of like my whole trading plan back then. And because everything in the 90s was going up in these, ridiculous bull markets, I looked a lot smarter than I really was. So because he was referring to things that I was not aware of at the time, and again, we're talking about 1993 is what this was. Yeah, 1993. I made fun of the guy, trolled him, everything a typical noob does to defend his team. Okay, I was a Larry Williams guy. Okay, everything was Larry Williams, kind of like what a lot of my guys and gals like to do with me, and I think it's silly, really. You don't need to champion me. Okay, I'm not anybody's hero. I'm not trying to be a super guru. I'm a real person, and I like to be able to invest my experience in the new people and relive all those moments myself. But I was ridiculing something back then, which happened to be Wyckoff, because of the silly names. Now, doesn't that sound funny? Because I'm the guy that coined the Judas swing, the SMT divergence. These are all rather silly names, but they were means of communicating something that I understood, but there was nothing for me to go and say to my sons, who I was talking about and teaching, in early stages of my career. These are things that I had to come up with to communicate basically what it is that I'm trying to say is occurring in price. And you can't come with very lofty theories, because if you're talking to a child, you kind of like make it as simple as possible. So most of the things that I used were rather elementary, and it works. So because of the names like spring, jump the creek, break the ice, these are all things that are synonymous with Wyckoff. I didn't like the idea of those names. I thought it was rather myopic, and I did not give it the attention that I think personally today it warrants. I don't believe that that's the answers, but I believe if you study it, you'll understand it a little bit about how markets price in runs, higher and lower. But it doesn't really come to the conclusion of what to do with it. It works beautiful in hindsight. It shows you what you could have seen if you understood what price was going to do next. So I see a lot of folks that are very cynical, argumentative about what I do. I have been on record before saying that I found supporting evidence in Wyckoff theory, but I had already arrived at seeing low resistance liquidity runs, like we're going to talk about here, okay, and the run on these equal lows. That was years before I understood what was being taught in Wyckoff. And when did I go back into Wyckoff and revisit that? It was 1997. One of the folks that I was working with on a one-on-one basis, because of his trading model and sharing what he was doing, his problems, his gaps in understanding were really the basis of me unlocking more depth to Wyckoff. So what I was doing is I was teaching one-on-one basis. People would come to my home, I would sit with them for a week, and I would explain to them how to trade the S&P and the bond market. Once in a while, if you were going to be a deviant, you would trade currencies. Well, the person I was working with had this affinity towards Wyckoff and didn't want to relinquish his hold on it. He wanted to kind of like take pieces of what I was doing and form fit it and push it into that idea and that theory. And it wasn't until like 2 or 3 weeks after our session together for the entire week I revisited some of his issues, and then right away I had like these epiphanies where I could see more about the things that I thought there were occurring in price. Wyckoff has a really simplistic approach to understanding the run up and the run down. Okay, so this would be a mark up in price, and this is a mark down in price. By far and large, it's too simplified. You need to know a little bit more about what causes these fluctuations in price, because otherwise it's going to be just like anything else. The harmonic pattern that worked in hindsight, the trend line, the perfect trend line that worked in hindsight, the ratio trade or the Fibonacci move, or all these things, you're going to be able to see that in hindsight. And I'm not disparaging anybody studying hindsight, because that's how I became Inner Circle Trader. No one was doing mentorships. No one was teaching people one-on-one. No one was doing what you see a lot of educators doing today. So you have a lot of advantages to you being a trader today, because you have a lot of resources, a lot of information, and it's right at the tip of your fingertips. You just reach out and take it off of the internet, watch videos, watch seminars, be a part of webinars, all those things. But but simply because the availability is there does not mean that you should be consuming in mass quantities a lot of the nonsense that's perpetuated as insight or trade education. So I'm going to give you my spin on this, okay, and you decide whether or not it's any value. Okay, if it doesn't have any value, if it doesn't resonate with you, then no big deal. You wasted probably about an hour with me. Okay, but I think that if you investigate it a little bit and dig into it a little bit deeper, you'll see that you're going to find what you don't really know you want to know right now. You will understand what it is that you lack, and by having that, well, epiphany of your own, you're going to be drawn in to learning more about it. And you can go into my free tutorials, and if that doesn't satisfy your curiosity or your insatiable desire to know more, then obviously you can consider my private mentorship. Okay, so take a look at the price action here. Okay, and what I want you to look at is that if we had a consolidation in here, yes, there was a run on stops below this low. Now again, mind you, this is a 1 minute chart, the very time frame that the professionals, and I'm doing this with quotations right now with my hands, the professionals will tell you there's only noise on these lower time frames, that no one can do this consistently. No one can know what's going to happen in price on a 1 minute chart. And anybody that tells you that they can is a con man and a liar, and run away from them. Okay, I'm giving you, in fairness, the other side of the coin. So if you subscribe to that view, don't just turn the video off now, and there it is. You've done your good deed to protect yourself and save yourself from learning nonsense, because then you'll follow the herd. But for all you apex predators in the making out there, if you want to stay tuned, this is what we're going to cover now. The consolidation that we have here, we have a run on stops. The sell side liquidity is taken here. We have a small little run here, comes back into the order block, and then it has a displacement. This run here takes out buy side liquidity, leaving this level of buy side liquidity. Now, what is buy side liquidity? Just buy stops. Anyone that would be interested in buying above on a breakout, or using a stop loss to protect a short position. Okay, because you have to use a buy stop to have protection. The only form of protection we have in terms of using a stop on a short would be a buy stop above some point of interest or concern that would, in your mind, say the trade is probably not good, and you want to be out and limit your losses to whatever that level would be. The price comes back down into, trades another order block, and I talk about this in the Sniper series if you don't want to know more about order blocks. Then we have a nice run here. This rally here falls short of the big figure. Big figure is 123 even. I have learned that there are times when prices run like this, they will, and it's commonly referred to as defending a level. And it's not really defending a level, it's the algorithm building in sentiment. And I'll talk a little bit about that here now. I'm going to put some lipstick on the chart, okay, and add some levels and some things, okay, but you're also going to see actual points of entry and exiting. I'll get to that later in the video, but for now, I want you to concentrate on the levels I'm going to put on the chart. Okay, so let's do that now. All right, so we have the consolidation in here. Now this is what I deem as a market maker sell model. Okay, we have the original consolidation here. Notice I'm not talking about the run over here, there. That's Wyckoff. I don't care about that because sometimes it won't have that little run below. Okay, I don't care about that. We have a consolidation. We have displacement, an initial run up. Here's the big figure right here, 123. Price runs up to it, and in my personal algorithm, my view is that this is a suspect rally, and they're going to draw it back lower because people will see that as a short forming and they're defending 123, which is exactly what I want them to believe. Price, as it ran up in here, I went short there, and I will show you the fills in a moment, but just right now, just understand the logic behind what I was doing. My expectation was it was going to drop down to here, back into the original consolidation, and then I could be a buyer. I had a limit order waiting to go long there, and here is that fill. And yes, you'll see all the data for this in a moment. Just for right now, follow along. I want to sell short here, buy it back, and then go long, which is going on here. Runs up, and then the exit is here. Okay? I'm exiting along above the 123 big figure. I also had a limit order to sell short above the 123 big figure, and that's occurring here. Okay? So 123 and 4.5 pips was my entry going short, and this area right in here, I teach this as the smart money reversal. This is a point of accumulation. Okay, so we have a consolidation, a run up. I can work in the high to the low to the high, and then we had a run lower. The smart money reversal has been confirmed with this breakdown. In this area over here, there's things I like to look for order blocks and such. That's what these down close candles are. I expected and anticipated a bounce here. We got it. It rallies back up to the middle of these green candles. Take the range on the bodies, not the wicks, because that's the part everybody gets tripped up in retail. The largest volume is going to be encapsulated in the bodies of the candle, and it occurs still on a 1 minute chart. So please, please, please consider where you get your information from, because there's so much information out there that is just complete and utter nonsense. And it does not matter if they came from Goldman Sachs. It does not matter if they came from XYZ Bank. It does not matter. These people out there that say that stuff, they don't know what they're talking about, and all they have to do is watch me on a weekly basis, and I will rip their theories to shreds. So that's my only soapbox moment, I promise. So we have this run up in here. That's a bearish order block. About the midpoint of that, okay, is what I teach as a mean threshold. It basically goes up the middle of that. As it was running up in there, that's when I sold short another portion. I was already short up here, right in here. I added more there and anticipated a run below these equal lows. That's the market maker sell model. That's mine. That's not Wyckoff. That's not anything else out there. Okay, it's mine. So my exits were limit orders right here, just below these equal lows. Now, there's other things that I teach that tells you exactly where this low forms and where this low forms. But because I'm doing it in public, it's not important. This is enough. Selling it here, buying it here, selling it here, selling more of it here, and then getting out here. Folks, you just don't see these types of fills and exits and understanding and price action by anybody else out there. Simply put, no one else is doing this. Done. How did I know about it? What were the things about this that kind of like gave me the confidence to trade off of it? The lows that were forming over here is 122.70. So 122.70, it was creating a dealing range low. A dealing range is anywhere between two price points that are very clearly defined as what would otherwise be referred to as a trading range. But the problem is it's not a specific or static range. It's an evolving range. So we have the initial range from this high to this low, I'm focusing on this here to here for the concept of the market maker sell model. That's the fractal I was envisioning in price that gave me the basis for these setups. Now, don't get mixed up thinking that this only works on a 1 minute chart. I want you to kind of like broaden your understanding and your perspective, and consider if this was a hourly chart, or if this was a daily chart, or a 4-hour chart, or even a weekly chart. Heck, even a monthly chart. This pattern still exists on all time frames. What that does for you is it makes these points of entry and uncovering and buying and getting out much more larger in magnitude and opportunity in terms of pips. I don't care about long-term trading, if you will. I just don't have the personality that matches up for that. But I teach how to do these things on any time frame. So you're not limited. You're not limited to scalping, which is what this is, or intraday trading with a 15-minute or a 60-minute chart, or a 4-hour chart for short-term trading, or a daily chart for swing trading, or a weekly chart for position long-term trading. You're not limited. So everything I'm teaching here, or illustrating, if it really is a better term for it, is that you can see what is likely to occur if you understand order flow. So we have 122.70, it consolidates from, then we have a displacement, we have an initial run up. Now I know some of you are saying, well, how do you know, or how didn't you know it wasn't going to go through that 123 big figure? That part I'm just going to have to keep to myself. And I know some of you are already hissing and moaning, oh, now see, you ain't teaching anything. That part of it I'm not teaching, okay? But I want you to understand that there are certain measures that you can do in price action relative to time and how fast it moves and what characteristics are in play on price right now that you will pick up with a little bit of insight and then a lot of study, okay? So trust me, no one taught me this. It was a matter of me digging into it. This part here, buying it down here, that is classic ICT. That's classic return back to the original consolidation for reaccumulation of longs. So you buy it here, expands up and reaches this initial run here. In theory, I'm just going to tell you here this part of it. I knew that they were selling a narrative that they want to price in a high around 123. Why did I believe that? Because yesterday we had a really nice run in cable, and generally there's going to be some measure of retracement, and they're going to come back and run on the funds. So the funds liquidity is what they're going to really tap into. Now, large trading funds are not working off a 1 minute chart. I will grant you that. Some of you are just shaking your heads. Oh, they don't trade off a 1 minute chart. I never really said that, but I already know what you're thinking. So if we know that they're going to likely run to 123, and they have a real quick run like this, usually it's going to be in 2 stages. You have the consolidation, it runs up initially, then you have the retracement. I'm going to sell short here just to prove that I know what I'm doing, and then buying it back on a limit down here with the expectation of running 123 big figure. I knew 123 was high probability, and I also knew it was a really, really high probability because of the high that they left here. People are going to see that spike up, and they see that wick, and all of a sudden they pull out their Steve Nielsen book, candlesticks, and everything else, and they think that it's the high. And they're going to be going short in here with their stop loss above this initial high. That point of liquidity creates a pocket of willing buyers. Well, that's exactly what I want to tap into because I'm bought down here. So I'm going to have a ability to give my long away to somebody that willingly wants to buy it at a higher price. So those buy stops that they sold short here, their protected buy stop is a mechanism to protect them from a larger loss. They think if this high is taken out, they're wrong. So they place their willful order to buy at the market covering their short position. This is the premise to reading the tape. It builds a narrative, understanding what's going on, who's at play, who's in the market right now, who stands to lose money, and who's making money right now. That's always the questions that's going through my mind all the time as I'm watching price. I sold to those buy stops, and then I also sold short to those buy stops. I used this pool of liquidity above this high, above the big figure, on both sides of the coin. I used it to exit my long, and then I went short on limit. as price broke this swing low here, that's a break in market structure. I teach that. This initial rally here, that's your low risk sell. What makes it a low risk sell? The narrative is already in play. They ran the stops here, consolidation. Everybody now that's long has their stop below these equal lows. That's what I'm going to target next from my initial short and in my low risk entry for selling short. You can see my entry here, and then the exit point is right at these equal lows, simply because anything else down here teaches mentorship level. But all of the things I just talked here is basically all free level content. Now, there's other levels in here that I have not commented on, and that is the 122.80 and the 122.90 level. Whenever we have a level that's round number, like 123, you commonly hear it referred to as a psychological level, and there's really nothing psychological about it. It's a matter of layered liquidity. Okay, so what do I mean by that? There's orders, like I just told you, I tapped into as exiting and entering on, because big figure 123 is the level that most people want to trade at, but larger traders like to work their orders just beyond that big figure because of what I just explained over here, and working with the liquidity and the narrative that's built around this particular fractal in GBP USD. So selling above 123 big figure, that would have been a specific setup that I teach. That's trading the big figure. Having a low resistance liquidity run, which is what I teach in month 1 of my mentorship, that is the basis of hitting the ground running as a trader. If you have no understanding of how to find consistency in trading, my first month in mentorship, that content will absolutely put you in a position where you'll see setups all the time. They're everywhere, every single day. That's why I have a kind of like a trademark expression that's used on my Twitter feed all the time, which is every week, every day, and it won't stop. That's our trademark. That's our mentorship, motto. I can find liquidity every single time frame, every single trading day, in every single market or asset class. It's the same thing everywhere. It's a secret sauce that only works in Forex. It's not. I've done this stuff in bonds. I did this in the S&P 500. I traded in futures markets, currency markets, the corn market, pork bellies when they used to trade. I did all these same things in those markets. Okay, so don't think that I'm just a one-trick pony or these concepts only apply to Forex, because they don't. They're completely universal. So, by having this view on price, I know that the 122.80 level, there's going to be orders down there. Why? Because that's an institutional price level that large traders, large bank traders, and order flow will reside around that 80 level. 123.20, which doesn't exist here, could be the next run they go above. If they take these highs out here, that would be the level that would be reasonable to anticipate as a upside draw on liquidity, because this pool of liquidity has been already purged. What resides now is the non-existent price delivery at the moment of this recording of 123.20, and I'm just going to put this in here for my own notes. So that way I'll have it for study too. I do this as well. I teach my students to take screen captures and preserve moments before, and I'm doing that now. Alright, so that's on my clipboard. So I'll have it when I need it, when I post it later on to my notes for later on. Alright, so we have below these equal lows, we have sell side liquidity. And what is that? That's sell stops. Okay, so we have a pool of liquidity that's been built up with a willing participants wanting to sell at lower prices. When price is up here, below these levels, there's someone that's long. So that collective group, which I don't care to know who they are, I just know that there are people long. They did not cause the buying pressure, okay? Okay, this is all repricing. This is algorithmic. This occurs because the price delivery from the central bank is always constantly moving up and down, and the algorithm works on a time basis. Okay, time and price. Where has it been in recent time? Well, it's been here. So once it's moved away and it creates this run and price begins to spool out, creates porous price action in here, it will want to come back and rebalance that at logical levels and then reprice higher to attack the highs above here. The algorithm does not really see your stop. Okay, now when I say the markets run your stop, it's autonomous. It's not completely what it used to be, where manually people would literally say, okay, this is where the next price is going to be at. Right now it's algorithmically and prices delivered that way. Manually, anytime, the central banks can come in and reprice and do whatever they want to do because it's their commodity. Price is their product. They have control over it. You can argue about that all you want. This market's too big to be manipulated. All that stuff, that garbage that's promoted in this industry, it's nonsense. Because if anything like that was true, I wouldn't be this precise. And it wouldn't be week after week, day after day, example after example of this type of precision. You don't get this unless you understand how prices are delivered from an algorithmic stance. From up here and here, I'm targeting willing participants that want to sell the GBP USD at that low price. Now, when they bought long in here, they're not thinking, I would love to sell GBP USD down here. That's not what they want. They don't want to do that. It's just a protective mechanism, their stop loss. But the market efficiency paradigm, which is what I teach as a collective, when price is up here, I'm not thinking it's going to keep going higher. I'm not looking at this as some kind of early stage of a 1, 2, 3 or some kind of a measured move. I'm not looking at any of that stuff. I'm looking at the liquidity that resides or resided above 123. And I seen this over here and said, okay, this is a no-brainer. I'm going to sell short here and here and attack that liquidity right here because it's obvious. It's equal lows. I teach this candidly, publicly on Twitter. Every single day, something is making these equal highs and equal lows, and I attack that. I don't look at this as a buy because it's a double bottom. I look at that as this is fresh meat. This is a victim waiting to bleed out. Now that may be a little graphic, it may be a little concerning for some of you sensitive folks, but I view the market with a predator mindset. I don't care about your feelings, and I don't care if you're upset if you lose your money. And I'm the other side of that trade. That's this business. And if you're not prepared for that, you're in the wrong industry. You got to get out of here because it's going to eat your lunch. It's going to hurt your feelings. It's going to dash your hopes. It's going to be hard. You're going to struggle, and it's going to feel like you're never getting it unless you learn from someone that knows what they're doing. Between these equal lows and the level of 123, there are specific price levels, and we round them to the nearest 10 level, and that's 2280 and 2290. The reasons why, just as we mentioned here, the liquidity that would rest between these lows right below it was 122.70, and in the 123 you have 122.90, which they will have orders in there as well, and you can see the order flow around that price level. 2280, the same thing. Really nice buy, keying off of that. You see my fills. And then run above the liquidity for 123, buy side liquidity. The expansion that took place here, it's creeping lower, creeping lower, creeping lower. This type of formation where it's elongated and spread out over time, this is only because it's on such a short time frame, 1 minute. The larger the time frame, the more, I guess, compressed these moments like this, and this. That's generally what you would see. One more level of all this elongated controlling price between the high here and the low in here. All of this would be really in maybe 3 or 4 or 5 candles, not so many candles here. Okay, so the only thing that I would subscribe to in view of order flow on a 1 minute chart is because of the element of time being 1 minute. Only thing it does is it distorts, if you will, the measure of amount of time it stays in the fractal. So what I mean by that is how much time did it stay in this little consolidation before it expanded up? How much time did it spend in its consolidation up here before it broke down? How much time did it spend in this consolidation before it broke down? when you're in the lower time frames, like 5 minute, 1 minute, the part that builds the next move before it expands higher or lower, whether you're using the market maker buy or sell model. This is, again, a sell model. What makes it a sell model is they consolidate price, they hold it there to allow sentiment to build. Breakout artists. So they reward the buyers here, so that way they can put their stop loss down here. That builds in or engineers liquidity. So when they run up to that 123 big figure, smart money and people like myself that are waiting for that to go short, we know that this is the move it's going to be running on. This is the area of liquidity that this run will tap into at a later time. The measure of time will be, again, skewed on the lower 1 minute chart because of it's a 1 minute chart. Price is not moving because of 1 minute or 5 minute, 15 minute, 60 minute, 30 minute, 3 minute, 60-second tick chart. It has nothing to do with it. It's just giving you a visual representation of where it's at right now in respect to what has traded in the past. Okay, so when we have an understanding of order flow, and then we understand open float, and we understand what the narrative is and what they're building, why should they take price to certain levels, and what did they leave intact? That's this. Okay, when you understand that, you're not caught off guard, you're not surprised, you're not confused. You're focused. You know exactly what you're looking for. You're not trying to chase price. Nothing in here is chasing price. This is exactly what a trader wants to know. Okay, when I first stepped out on the scenes with babypips.com, I went into that forum in 2010 and just said, look, I know what you're looking for. I know exactly what you as a developing trader want to know. And I know the things that you don't even know you want to know yet. That's how far ahead of the curve I am. Now, I'm not here to beat my chest. I'm just here to be the other side of the coin when these folks that are supposed professionals get out there and post videos on YouTube and say that lower time frames are just noise, and anyone that tells you they can time the market on these lower time frames is a con man, they're a liar, and run away. Okay, let's look at the actual fills here. All right, this is the part that everybody likes to worry about here. Okay, and I did this today because it's on YouTube, and I'm satisfying the little itch that these guys, usually the younger guys, like the 20-year-olds or so, they like to see these numbers here. And this is the least important. Okay, this is the least important. I want you to focus on the prices. Okay, these prices and how we move from these price points up here. Okay, from here to here, and from here and here and here. Okay, so it's not meant to say, look how smart I am and look how much money I'm making, because I've illustrated this with a demo account. I'm very clear about this as an educator, because in the United States we have governing bodies that are very, very motivated to protect people from scam artists, from Ponzi schemes, and from people that would otherwise hurt you. My intentions are not to hurt you. I want you to be stimulated to learn more about this, and it doesn't really necessarily mean that you join my mentorship, because joining the mentorship costs money. You have to pay $155 for 12 months, and then you pay a $150 conversion fee, and that's it. It doesn't happen anymore. You don't pay anymore. I had to raise the money or charge for it up because PayPal has increased after 3 years working with them. They're the only payment processor that I use. So if you can't do PayPal, you can't be part of my mentorship. And I apologize, but it's just the way it is. I'm sorry. So once you are in the mentorship and you pay your 12 months and you pay your charter conversion fee, that means you're done paying. But you have access to everything that you paid for and ongoing education, and you're part of the community. I am not a for life membership. You don't keep paying me forever just to be a part of the group, but you do have to pay for your seat. Your seat is the charter seat. Charter is continued learning without having to pay for it. I have people that joined in 2016. They're charter members. They have not paid me a dime since they paid for their conversion fee and charter membership. It's done. That's what you're paying for. You're paying to be part of my community. And I talk about what the markets are going to most likely do. I outline things that will possibly unfold. And I'll leave it up to you to decide. I have a lot of people that are in my mentorship. A lot of people. And they will tell you in the comments that I'm lying if I tell you that we are in a 90% bracket in terms of our long-term analysis and the suggested outlines that what price should move. I do this on an hourly chart and on a 15-minute chart and on a daily chart. You're looking at me doing it on a 1-minute chart. The problem with this is going to be some of you that have been in this industry for a while know that the scams that associate themselves with using, I just had a guy mention it on Twitter. I don't know if I'm using a strategy tester or something to that effect. These moves, okay, are done on a 1-minute chart, but it's the same thing that I do and outline on a 15-minute chart, an hourly chart, and on a daily chart. And I only do 2 videos per week. I do it on Wednesday and on a Friday. And when you're doing that level of higher time frame analysis and it still unfolds to the pip, there's no back testing strategy tester that I can't do that. You're talking about time travel now. Okay. All I did by using the 1-minute chart here is to answer it in a very convincing fashion. I believe that there's really not noise on this time frame. It's the same thing. Price is going to be the same on all time frames. Like when you're looking at price action and it's saying that it's offering price at 122.93, okay? Everyone's chart platform is going to be really close to that 122.93. There's going to be slightly different variance because of brokers offering spreads, and spreads are going to vary across brokers. This price delivery, it doesn't make a difference. It does not make a difference what time frame you're using, because price is price. If you look at price on your own, okay, and this is one of the paradigm shifts that took place for me. Because I was always trying to seek the best time frame. Which is the time frame that the banks are using right now? That was my initial question I put in my trading journals back in the 90s, because I wanted to know what time frame they were using. Because if I could use that time frame, shoot, I would have it all figured out then, because I knew how I'm doing the bull flags and the trend lines and the head and shoulders, all that stuff that doesn't work. Okay, my view back then was, it's the time frame. That's got to be it. That's the time frame. The banks. Every week I was changing my mind about what was the right thing, the secret sauce, and it's liquidity. That's the thing that's outside of your chart that makes this whole thing work. It's where the money is. Okay, where are the orders? Because if you understand that, you won't be tripped up by any of these goober patterns, okay, that people write books and sell courses about that has no basis for why price is going up and down. It has nothing to do with why price is moving. But it sells books. It fills webinar seats and workshops on the weekend. Everybody dog piles into that kind of stuff because they think they're getting something of value. And they're just getting one more gimmick that doesn't hold water. So, what did you learn here today? Well, probably not a whole lot. But this is just to instigate a moment in time for you to decide whether or not there's any validity to the things I talk about. There's hundreds of hours of videos that are available in free format. It doesn't cost you any money to see if I'm full of crap or not. Just because I'm doing this, and I wasn't telling you before it happened, because I do not give signal services. I do not tell people in the mentorship, we're going to buy here, we're going to sell here. I tell them where the market's going to go. In my course material, I teach how to pull out the system, the signal, the setup, the pattern, the take profit, where the stop goes. All that is in the teachings. I play spotter. You're the sniper. I point, you shoot. You learn that way. You don't learn by me saying, all right, I'm buying here. Everybody put their stop where I'm putting my stop. Everybody put their take profit where that's not mentorship. That's not what I do. That's not what I do at all. On Wednesday, the midweek, well, let me say it the right way. At the end of the week, Okay, usually on a Friday or a Saturday, I do a weekly review. And I talk about what we saw transpire and pan out, or what's left in the marketplace to still likely pan out. Or I will tell you I need more information and I'm waiting for Monday's trading, and then I'll update the group if there's something that is of importance. Otherwise, on Wednesday, midweek, I do a midweek review. And again, I talk about what has happened, and then I outline what reasons are in play for the market to behave a certain way and trade up to a specific level or down to a specific level, and what conditions would be there to negate either one of those things. I do not go in there and say, here's scenario A, okay, and if it does this, I'm going to look smart. And I don't say, here's scenario B, and if it works out like that, I'm smart. I tell you exactly what side of the market I'm favoring. And again, if I'm lying, my mentorship group is welcome in the comment section to say I'm exaggerating, that I'm lying, that I'm misrepresenting. They are welcome to do so. But if I'm not lying, and you don't see a flood of people, and I'm not going to be deleting comments in the comment section from people that are saying that they're mentorship level, because if they come in there and say they're mentorship level and they say I'm embellishing on the truth here, the other members will come in and say that they're lying. Okay, so I'm not going to be deleting anything. So nonetheless, you don't have to like me as a person. Okay, I've never been here to try to be everyone's friend. I came out just to answer all of the bull that is on baby pips back then and still to this day. The things that you are fed as a steady diet in learning how to trade, how to invest, how to make money, what things work in the marketplace. I'm telling you, 99.99999% of it is bull. It will lose money. You will lose money. In the times that you do win, you're going to falsely attribute it to skill or your system. And it had nothing to do with it. Nothing to do with it. Price is doing what it does from an algorithmic standpoint, and it's predetermined. It's all by time and price. And I don't care if you don't believe me. I don't care. I make a living at this. Okay, I predict this stuff every single week, and I show examples of it every single week on Twitter, and it costs you nothing but a simple look at it, and there it is. Most of my videos are 45 seconds long, and it's done. My rants, they could be a little bit long, but the things I tweet are generally answers to emails. Okay, so I don't have a whole lot of time, and most of my responses, if I do respond by email, is very short, much like I tweet. Okay, very short to the point. I try not to have long, lengthy conversations like some of you would rather me do with you in email. I just don't have the luxury of time. And most of the time when I'm tweeting, I'm out and about, and I'm doing that while I'm doing other things. So I'm not sitting home in my basement, okay, in the dark, with Marvel character posters around me and popcorn kernels on the floor and potato chips all broken up in my lap. I'm literally doing other things. I'm walking somewhere. I'm out and about. I'm waiting for my lunch to be served to me, or I'm going out to dinner and I'm waiting for that. I'm doing other things when I'm doing it. So just know that there are things that you're going to learn with me that's going to be unsettling, because I'm going to ruffle your feathers and really challenge your tried and true love of a certain style, of a certain mentor, a certain approach to trading. I'm going to upset that. And I'm telling you I'm going to do it ahead of time, and I'm telling you also I'm not apologizing for it. Because if I could go back in time, I want to know the things I tell you all. I would love to have been told and shown example after example from someone that knows how to do this. That would have saved me fortunes. It would have saved me peace of mind. It would have saved me my relationships. It would have saved me my health. Those are the problems that you're going to get if you don't listen. If you just want to go through this world and invest and feel like you're smart and you figured it all out, well, be my guest. There's people that make money and not trade what I do. I'm not oblivious to that. I know that occurs. But if we were to sit in a one-on-one and compare and contrast notes and experiences, I can tell you that I don't feel any of those things that you're going to tell me you feel. I don't have any of those adversities. I don't have any of the confusion. I don't have any of the doubts I don't have any of that stuff. I know exactly what I'm doing, when I'm going to do it, and why. I know what I can do in price action, and I also know when there's times in the marketplace I'm just literally not interested in. Most people don't have that level of confidence, which is very, very frequently viewed as arrogance. And it's not arrogance, it's just confidence. And once you learn how to do it effectively yourself, you will know what it means to be this confident. It's not arrogance, it's not pomp, it's literally knowing what you're doing. Are you a pompous, arrogant person because you know how to do your job that you go to every day? When people come in, they visit, and they see you doing your job. Are you arrogant because you're doing it right? And you understand why you're doing everything that you're doing? No, of course not. You're versed. You are initiated. You know what you're doing. Outwardly, people that watch me and they listen to me, they, either I'm going to be loved by you or I'm going to be like fingernails on a chalkboard. It's going to be just irritating. I'm okay with either one of them because it doesn't take away from me. I still do what I'm going to do, and there's nothing changing it. I know any given day of the week I can go in and do what I'm doing here every single day. I just don't have the time to do it every single day because I'm doing every other thing that makes me a father, a husband, a brother, a friend, and a mentor, and I'm running businesses. So I do all these things when time is allowing me to do so. There's a lot of things you're going to read about me on the internet if you listen and do a lot of research. Some will say that I can't trade. Some will say that I back out of trading contests. Some will say I blew accounts. All that stuff was when I was trolling and trying to be fun and just not taking myself serious. In recent months, last 19 months, I have been all business on social media and showing exactly what I've always been able to do. And I have to do that because I'm running a business. Before that, I could be taken as a comic online, okay, and don't be taking me serious on there. And I had fun, but I want you to really, if you're going to take the time, balance everything. Don't just take someone's opinion about me. Dig into it yourself, and you see, because I promise you, you will learn things that no one will teach you anywhere else. So I'll talk to you next time. Wish good luck in good trading.